Everyone thinks the only way to make money in real estate is by flipping houses or being a landlord. I'm here to tell you that's just not true. There's a whole other world out there, a little-known secret that the big shots have been using for years. It's a way to get into the real estate game without ever swinging a hammer or dealing with a leaky toilet at midnight. It's called note investing. Quick myth buster. When you buy a note, do you own the house? No. This is one of the biggest misconceptions about note investing. Here's the truth. The deed stays with the homeowner. They remain the legal owner of the property. What you're buying is the note, the promise to pay, and the mortgage or deed of trust that secures it. Think of it this way. You're not buying the house, you're buying the debt attached to the house. That means you're now the lender collecting payments. Now, if the borrower stops paying, that's when you can step in and start a foreclosure process. If foreclosure goes through, then and only then, the deed can transfer to you or whoever buys the property at auction. So the key takeaway, buying notes makes you the bank, not the landlord. I know it sounds complicated, like something only Wall Street guys in fancy suits would do. But trust me, it's simpler than you think. It's about buying the loan, not the house. And the best part? You can get started with a lot less money than you'd need to buy a property outright. I know some people have built businesses from the ground up with as little as a $1,000 loan. So I know a thing or two about spotting an opportunity and making the most of it. This is one of those opportunities. Think of it like this. Instead of owning the property, you become the bank. You get to collect the payments and you get to call the shots. It's a powerful position to be in, and it's completely accessible to regular people like you. This isn't some get-rich-quick scheme. It's a real, tangible business strategy. It requires smarts, a little bit of grit, and the willingness to learn. But if you have those things, you're already halfway there. Over my years of watching many episodes of Shark Tank, I've seen thousands of pitches. The ones that always get my attention are the ones with a clear path to profit and a smart way to manage risk. Note investing fits that bill perfectly. You're buying an asset, the mortgage loan, often for pennies on the dollar. All right, let's get down to business. What exactly is a mortgage note? Don't let the fancy name scare you. A mortgage note is just a piece of paper, an IOU. When someone buys a house, they sign two main documents. One is the mortgage or deed of trust, which gives the bank the right to take the house if the borrower stops paying. The other document is the mortgage note. This is the borrower's promise to pay back the loan. It spells out all the details. How much they borrowed, the interest rate, the monthly payment amount for how long they'll be paying. It's the legal contract, the heart of the deal. So, when you buy a mortgage note, you are literally buying that IOU. You are stepping into the bank's shoes. The original lender, the bank, sells you their right to collect those monthly payments. From that moment on, the homeowner owes the money to you, not the bank. You become the lender. It's a surprisingly simple concept. The bank gets cash right away, which they love, and you get a stream of income or an asset you can work with. Banks do this all the time. They are in the business of lending money, not managing thousands of individual loans for 30 years. They'd rather sell them off and use that cash to make new loans. Think of it like this. Imagine your cousin borrows $500 from you and writes it down on a napkin. Now, not all mortgage notes are created equal. They come in two main flavors, performing and non-performing. Performing note, happy homeowner pays on time. Non-performing note, worried homeowner behind on payments. The first kind is called a performing note. The gold standard, the straight-A student. The homeowner is making payments on time every month. The loan is performing exactly as it should. You buy a performing note, you buy a steady stream of income. Like buying a rental with a perfect tenant. Example, remaining balance, $80,000. You might pay $75,000. Homeowner pays you $600 a month. You collect that check each month. It's a relatively passive way to earn a solid return, often better than a savings account or a CD. The second flavor, non-performing note, the problem child. A non-performing note, or NPN, is a loan where the homeowner has stopped making their payments, 90 days behind, 6 months behind, even years behind. These loans give banks headaches. Banks incur legal fees. Banks incur administrative time, and they aren't generating any income. Banks are desperate to get these off their books. Because they are risky and require work, banks sell non-performing notes at a massive discount. Let's break down how to spot a profitable note deal. First, look at the current property value versus what you pay for the note. This is called investment to value, or ITV. The formula is ITV equals the price you pay for the note divided by the property value. For example, if a property is worth $200,000 and you buy the note for $60,000, your ITV is 30%. That's a strong equity cushion. Most note investors target an ITV of 65% or lower to protect against market drops or foreclosure costs. Next, analyze cash flow. For performing notes, compare the monthly payment to your purchase price. For example, if you buy a $50,000 note and the borrower pays $500 per month, that's $6,000 per year, or a 12% yield. Most investors look for 10 to 15% annual returns. A profitable note gives you multiple exit strategies. You can hold for cash flow, flip the note, modify the loan, or foreclose if needed. The more exit options you have, the safer and more profitable the deal. Always do your due diligence. Check the borrower's payment history, the property's market strength, your lien position, state foreclosure laws, and all servicing costs. Here's a quick example. A property worth $180,000, note balance $100,000, you buy for $45,000. If the borrower reinstates and pays $800 per month, that's $9,600 per year, or a 21% return. You could also sell the now performing note for $70,000 and lock in a $25,000 profit. Watch out for red flags like high ITV, distressed markets, second liens, long foreclosure timelines, or borrower bankruptcies. Bottom line, buy at a discount. Have a strong collateral cushion, cash flow, multiple exit strategies, and manageable legal timelines. This is where the real opportunity for big profits lies, if you have the stomach for it. Example, a house worth $150,000. Unpaid loan balance, $100,000. The bank might sell that note for just $40,000. So how do you actually get your hands on these notes? It's not like you can just walk into your local Bank of America and ask to see their list of bad loans. This is a business built on relationships and knowing where to look. Sellers are typically banks, credit unions, hedge funds, other private note investors. They often sell these notes in large pools, bundling hundreds together. You don't need millions to play. Mid-size funds buy pools and break them up, selling individual notes to smaller investors. First step, find the sellers. Networking at real estate and note investing conferences, joining online forums, connecting with specialized brokers, online platforms like an eBay for mortgage notes. Use these platforms to learn what's available. There are several online marketplaces and platforms where you can buy and sell mortgage notes. Some of the most popular include PaperStack, a modern digital marketplace for notes; NoteTrader, a private marketplace for qualified investors; Crexi, which focuses on commercial note deals; and Notes Direct, which simplifies access to mortgage notes. You can also explore broker-focused networks like FCI Exchange, Loan MLS, and Amerinote Exchange. For fractional investment platforms like Constitution Lending and peer-to-peer sites such as Fundrise, Realty Mogul, and PeerStreet offer options to invest in real estate debt. Don't forget about direct outreach to banks, joining real estate communities like BiggerPockets, and searching public records for off-market opportunities. Notes range widely. Example, a $20,000 home loan, or a $300,000 suburban house loan. Get on sellers' email lists so you get new listings. Once you have a list, the real work begins. Due diligence. You can't skip this. It's the most important step. First, look at the property. What's it worth today? Use online tools like Zillow, or hire a local real estate agent to provide a broker price opinion, BPO. Know the value of your collateral. If the house is worth $50,000, don't pay $60,000 for the note. The cost of a real estate attorney for a typical note investment, expect to budget between $500 and $1,500 if you're looking for flat fee document review and contract support. If you're handling multiple notes or more complex deals, like defaults or foreclosures, costs can reach $2,000 to $5,000 or more, especially in urban or high-stakes scenarios. Always ask attorneys whether they offer flat fee structures and get a written fee agreement. This helps avoid surprises and keeps your investing process on solid ground. One of the most exciting strategies in note investing is what we call flipping a note. This isn't about holding on to the note for years, it's about buying it, improving its value, and reselling it for a quick profit. It's like flipping a house, but from your home office with paperwork. Buy a non-performing note at a deep discount. Turn it back into a performing note. Non-performing, investor works with homeowner. Re-performing, sold to new investor. Performing notes are far more valuable. Other investors want them for passive income. Example, one with a $100,000 balance. You bought it for $40,000. Your first move is to contact the homeowner. Remember, your goal is to be a problem solver, not a predator. You reach out with a friendly tone and say something like, "Hi, I'm your new lender. I see you've had some trouble, and I'd like to help find a solution that keeps you in your home." You can offer them a loan modification. For example, you could lower their interest rate, or extend the term of the loan to make the monthly payment more affordable. Let's say you agree on a new payment plan, and the homeowner starts making regular payments again. After they've made consistent payments for, say, 6 to 12 months, that note is now considered a re-performing note. It has been seasoned. It has proven that it's back on track. Now that IOU you bought for $40,000 is much more valuable. Because the note is now performing, that other investor might be willing to pay you $65,000 for it. That's a $25,000 profit in about a year. You created a true win-win-win situation. Now, I'd be lying if I said this was all sunshine and rainbows. Like any investment, there are risks. I've always said the best way to succeed is to know what can go wrong before it does. The biggest risk in note investing is buying a bad asset. This usually happens because of poor due diligence. You might overpay for a note because you got the property value wrong. Maybe the house is in a terrible neighborhood. Or worse, it's been torn down or burned to the ground. You absolutely must verify the condition and value of the collateral. Never, ever trust the seller's numbers without doing your own homework. Another huge risk is the legal side of things. Foreclosure laws vary wildly from state to state. In some states, it can be a long and expensive process to take possession if the borrower won't cooperate. You also have to worry about title issues. There could be other liens on the property, like a second mortgage or unpaid property taxes. Liens that come before yours can block your claim. This is why having a good real estate attorney on your team is not a luxury, it's a necessity. You might buy a non-performing note with the best intentions of helping the homeowner, but they might refuse to work with you. They might not answer your calls or letters. In the worst-case scenario, the borrower could declare bankruptcy, which puts a temporary stop to all collection and foreclosure efforts. So, how do you protect yourself? First, get educated, and finally, start small. Let me tell you about a woman named Maria, a schoolteacher from Ohio. She was great at her job, but worried about retirement. Her teacher's salary wouldn't be enough for the life she wanted. She'd saved about $10,000 and wanted it to grow faster than her 401k. She heard about note investing and was intrigued. She spent 6 months reading books, watching videos, joining online forums. She was scared, more scared of doing nothing, so she took the plunge. Maria found a non-performing note on a small single-family home in Indiana. The unpaid loan balance was about $50,000. The house was worth only about $35,000. The loan was underwater, so the bank was desperate. After due diligence, photos of the house, a title search, Maria offered $8,000 for the note. The seller, a small fund, accepted. She now owned a $50,000 IOU for the price of a used car. She contacted the homeowner, a single dad who'd lost his job but had recently started working again. Maria listened and offered a deal. The house is worth about $35,000. How about we modify the loan? Reduce your principal to $30,000. Set payments at $350 a month? It paid her $4,200 a year on her $8,000 investment. That's a 52% annual return. Here's another one I love. It's about a young guy named Tom, a mechanic, from a small town in Pennsylvania. He was good with his hands, but he knew he didn't want to be turning wrenches his whole life. He wanted a business he could run from his computer. Problem: almost no money to start. Good credit, about $2,000 in savings. He learned you don't always have to use your own money. He reached out to an investor, a dentist, who agreed to put money into the deal to help Tom buy the note. Tom and the dentist each walked away with over $27,000 in profit. Tom made a life-changing amount of money on his very first deal without using a penny of his own cash. Feeling inspired? I hope so. You've seen that this is a real, achievable business for everyday people. The stories of Maria and Tom show that you don't need a fancy degree or a pile of cash to get started. What you need is a plan. So, what are your first steps? The most important thing you can do right now is to commit to education. Don't even think about buying a note until you understand the fundamentals. Start by reading books on note investing. Consider joining a forum. Build a team to include an attorney, accountant, or an investor if necessary. Analyze 10 deals. Next, immerse yourself in the community. Go online and find forums like Bigger Pockets. Look for Facebook groups dedicated to note investing. Listen to podcasts on the topic. You will learn the language, hear about real deals, ask questions. The only dumb question is the one you don't ask. You can also look for online courses or attend local workshops. But be careful, vet the instructor, and make sure they are an active, successful investor themselves. As you're learning, start acting like an investor. Begin looking at note-selling platforms. Get on the mailing lists of brokers. Start analyzing the tape, that spreadsheet of notes for sale. Practice doing due diligence on a few notes. This is like practicing in a flight simulator before you ever fly a real plane. This practice will build your confidence and train your eye to spot a good deal. It costs you nothing but your time. Finally, start building your team and your funding plan. Take that first step today. Pick up a book. Your future as an investor is waiting. Go get it. Thank you for joining us here on Building Wealth Today TV. I hope this episode has inspired you to take control and start building your financial future, because there's no better time than today to begin. If you found value in today's episode, like subscribe and share it with someone who needs to hear this message.